Welcome, everybody. Welcome to all of our new attendees. Everybody that's here for the first time, would you mind just raising your hand? Yeah, that's awesome. Great. We love seeing our repeat visitors and also lots of new people, lots of new faces. So the Creative Calgary Meetup, we're all about connecting like-minded investors, entrepreneurs, operators, and professionals who are actively building real estate businesses, and for newbies that just want to learn and get started as well. So welcome. We're, of course, excited to have you all here and encourage you to continue to introduce yourselves and network as the night goes on. We've got some exciting things happening tonight. So our sponsor tonight is Lions Den Capital, and we're excited that they're able to sponsor us this evening. Lions Den specializes in high net worth individuals and businesses and helps them earn above average returns through private mortgage investments, while also supporting borrowers with strategic mortgage solutions. And do a quick introduction of our board members. So myself, Stephen Lower, and Mitch Hardington, who you're going to hear from in a little bit, and also Nathan Turner, who's not with us this evening. If you guys had a chance, Nathan was presenting last week, so he gave a little spiel on what he does. So next, we're going to jump down to, yes, we just got a bunch of announcements, so you guys are going to have to bear with me. We'll get to our speakers in a minute. We're all pretty excited to see them. So we're going to start something pretty new and exciting. So we're doing something called the Creative Power Hour. So Dustin Brandon, if you guys remember, Dustin spoke with me a while back. Dustin Brandon and I, we're going to be doing a weekly Zoom meeting to help people that have more questions after these events. So Tom is driving all the way up from the Crow's Nest Pass. We got people coming all the way from Edmonton. So we thought that this would be a good way to do a Zoom meeting where people can come from all over Western Canada, come together and learn about creative finance. So I believe, is this the QR code on? Yeah. So if you want to get the details for the event for the Creative Power Hour, scan the QR code and you can get the link for our Zoom meeting. It's starting tomorrow at 6 p.m. and every Wednesday. And we had 3 people booked for our speaking arrangements tonight. Unfortunately, Jennifer Champion was not able to attend, so she had some family commitments she couldn't change. And so we were privileged to have these 2 speakers. So I'm like, you guys got to lengthen your presentation a little bit. So we're going to have, today's topic, of course, is more money, less problems. Right, Natasha? We're going to talk about a lot of problems. Good. So we're going to hear from Natasha first. So Natasha, over her last 6 years, I'm going to do the introduction of both, and then they can just fly. You guys don't need to hear from me again. So Natasha, over the last 6 years, has built a $15 million real estate portfolio while generating double-digit returns for her investors. Her experience spans flips, BRRRRs, long-term rentals, short-term rentals, multifamily assets, and development projects. She specializes in acquisitions, deal structuring, and asset management with a strong focus on scalable investment strategies. And after that, we'll hear from Mitch. Mitch Hardington is a real estate developer and business operator focused on ground-up residential construction and acquiring profitable home service companies. He's managed over $150 million in luxury residential construction projects and has successfully scaled businesses through operational improvements and system implementation. Today, he's actively developing residential projects across the United States while continuing to pursue strategic acquisitions nationwide. Let's hear it for our amazing speakers.
How's everybody doing tonight?
Great.
Good. Couple women in the room. I love to see it. I'm used to this. So who here has done development? Put your hand up. Really? Okay. Who here is interested in getting into development? Okay, great. You're in the right spot. Okay, who's here has done a flip or a BRRRR? Okay, a lot of people have done a flip and a BRRRR. So everyone understands the concept of what a flip is and or what a BRRRR project is. Good. Okay. So basically a flip, you buy a house, you renovate it, and then you sell it for more than you bought it and you make a profit, right? Simple. A BRRRR is when you buy something, you renovate it, you rent it out, and then you refinance and you try to take out as much money out of the project, and then you repeat it. You do that over and over so that you can buy and hold the assets, but you don't leave your money in the asset. So the biggest difference between a flip and a BRRRR is a flip, it's a quick in and out, and you're selling the deal. A BRRRR, you are holding onto the properties. So development is no different. if you are buying it and then you are developing the space and then you're selling it, it's the same concept as a flip. And then if you are buying it, building it, renting it out, and holding on to it, refinancing at the end, you're basically just doing a BRRRR. So same idea as a single family. It is the same as development. And of course, you can develop a single family house or multifamily. The the most popular thing these days is developing multifamily, fourplexes, eightplexes, or more. Let's see. I wrote notes because I don't have a presentation, so bear with me. So what's the biggest barrier to entry into getting into development? I want to hear from you. Capital?
Experience.
Capital, experience.
Contractor you can trust.
Well, we'll get there. Anything else?
Leads.
Market. The market?
Lenders.
Okay.
Leads.
Leads for properties?
Yeah.
Okay. Anything else? Okay. It's the exact same problems if you are buying a flip or if you're buying a BRRRR. It's the same problems. There's going to be a little more problems though, but more money, right? So there's the concept of risk versus reward. So the lower risk, usually you have a little bit more stability, right? Higher risk, higher potential for higher reward, right? So if you think of a flip project, how much on average do you make on a flip project?
60,000. 30.
Anything else? Okay, so let's say between $30,000 and $100,000 you make on a flip. Now, I would just add a zero for development if you're doing multifamily. So it's a bigger deal, but more money. And there's money to be made at every single stage with development. So let's say when you're buying a flip, the process, usually you're buying it from a wholesaler, right? So someone else found the lead, they did the work, found the lead, but they don't want to do the work of the renovations or the risk of holding the project or anything like that. So they're assigning that contract to somebody who wants to put the work in to flip the property. That's one stage, right? And they make a small little profit for doing the work of sourcing the deal, let's say, and negotiating and all of that. So let's say that person makes, I don't know, $10,000 to $30,000. Then the flipper should be making, let's say, between $50,000 to $100,000. They're taking on a little more risk. They're doing a lot more work. That's kind of next stage, right? Then the next one, maybe an investor comes in and they want to buy this flip because it's got 2 suites and they want to rent it out. A lot less risk in that phase. But there's money to be made at every phase. So same idea with development. When you, let's say, buy a piece of land that's got a house on it, and then you get the permits to build, let's say, a fourplex. And then you knock that fourplex down, and then you just sell it at that point. You don't have to go through the whole entire development. And you make some money just because you either did the rezoning, you did the process of the development permit. Because development permits, they can take 6 to 9 months.
Or 18.
18? Yeah, that's a risky portion of the project is waiting for that development permit to come in. And there's carrying costs usually if you could do it creatively, but let's say for the most part, there's carrying costs. So next phase, of course, you can either you can rezone it, sell it, you can get development permit, sell it, you can build it, sell it. Like there's all the different phases. You don't have to go through the whole thing. So I keep referring this to a flip because a lot of people think of development and they're like, they have no idea where to start. It's like this massive thing that they never think that they're even capable of doing because that's what developers do, and I'm not a developer. I'm gonna tell you, I'm doing a development and it's crazy. I can't even believe, look at me. I'm 20, I'm not gonna say, I'm 30 something, I don't know. Just kidding. So I'm doing my first, actually no. I'm still in my first development that we started over a year ago. And we haven't even gotten in the ground yet, but I'll get in there. I'll get into the details there. Any questions so far? Feel free to just raise your hand if you have any questions. If I say something you don't understand, a term you don't understand, a concept you don't understand. I'm not really doing a presentation. This is like a conversation. So feel free. And it gets a little quiet.
You're starting for the first time, right? Do you buy property put on rent or just do the flip? Which strategy is best?
Depends on your goals. It depends on 5 things. Your goals, right? So everyone has a different goal. If someone's got no time to do anything, but they have money and they want to invest their money in real estate, they're probably buying a turnkey rental property that doesn't need renovations because they don't have the time to deal with that. But if you are someone who's got some more time and has no money and you want to get into real estate, maybe you're doing some wholesaling or some flipping to get in the game. So it depends on someone's goals. Number 1. Number 2, depends on how much time you have. 3, it depends on your skills and your knowledge. Number 4, how much money you have. Now you can have the skill of raising money or making creative deals, but for the most part, you're going to need money. And 5, you need to be able to qualify for financing or find someone who can qualify for financing. But those are the 5 pieces. Number 1 is your goals. Does that answer your question? I hope so. Okay. So, biggest barriers to entry. So, number 1, for a development. So, approval for your project. And if it needs rezoning, it's even going to take even longer and a harder process. 2 is usually carrying costs for development. It's usually, because usually when you're doing a flip, it's short term. If you're doing a BRRRR, again, you're getting short term financing and then you're moving into a lending. So there's not a huge burden of these carrying costs. But for a private loan, for doing development, you could be, it depends on how big your project is, but the carrying costs are probably some of the biggest barriers to entry. Unknown variables, such as the build cost, hard costs, soft costs, variables outside of your control, like permitting, large liquidity requirements, and a lot of people are using MLI Select these days for buying and constructing. So a barrier I would say is potentially not understanding your financing options. And the variable would be MLI changes. I don't know if anyone knows about MLI, but it's awesome. Okay. Let's see here. So I talked about the flip, how it's the same as a development. Okay, so same concepts as a flip and the development. What do you know? How do you be successful in a flip?
Sell for higher than you bought it.
You do it quickly.
Sell for higher than you bought it.
Keep your carrying costs as low as possible.
Yeah.
You're into construction, and then if you can do it by yourself, it's gonna be better because you can put down your cost lower, and then you can do it by yourself and then sell for more.
Depends on your goals. Can you do 10 flips at once?
No.
Anyways,
Yeah.
but good, exactly. You can use your skills though. Anything else? Okay. So buying it at the right price. I think that's one of the biggest ones. So if you don't have enough margin to do a flip, you could lose your money very quickly, very easily, right? So buying it at the right price. You know what it's going to be valued at the end, minusing the cost to build, the carrying costs, lending costs, whatever it is. You minus all of the expenses, and that's your dollar price. Actually, minus your profit that you want too, right? For me, if I'm doing a flip, it's minimum 50K. For someone else, maybe they'll do it for 10K. Everyone's got a different number, which is why everyone comes out at different prices when they put offers out. But number 1 is buying it at the right price and knowing your numbers. Because again, your financing might be different than somebody else's financing, but you need to know what your financing costs are going to be, what your plan, what your strategy is. So it's going to make sense. So having an advantage by being able to do it cheaper. So if you are a builder and you can do most of it yourself, if you're just a GC, maybe you're doing the GC work and you're saving some costs there. Knowing your exit strategy. So I've seen some people that get into things and they're like, well, I could sell it, I could BRRRR it, I could do Airbnbs with it. I think that is a recipe for disaster. You need a plan A, and you can have plan B, plan C as optional things if plan A doesn't work out. Because obviously things can happen and things change. So having multiple plans is good, but not having that exit strategy is recipe for disaster.
I got a question.
Yeah.
And it's just a basic one on the term exit strategy, which I got my interpretation of it. I just want to know if it's right. So the exit strategy isn't getting out of the asset at the end. It's after you acquire it, it's what you're going to do with it, correct? Per se?
Not, I would say what the plan is, like let's say if it's development,
Yeah.
what are you doing after you build it? Is the exit strategy to exit and sell it? Is the exit strategy to refinance it and keep it? I would say after the build, or if you're doing a flip, after the renovation, are you refinancing or are you selling?
Yeah, like if I bought a single family home and I wanted to turn it into co-living would be my exit strategy.
Yeah.
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 Just wanted to make sure I had that right in my head.
Yeah. And that's the thing with, I find terms in real estate is they can be interchangeable. A lot of them can be sometimes just ideas. Sometimes people will say a term and then it'll confuse someone else, but it means the same thing. So it's absolutely valid. So if anyone else has any questions about the terms that I use, feel free to ask and verify, because that's what we're here to do. Yeah.
How do you know the right price? Because of course the seller also knows what's happening in the market, right? So like in terms of like if I'm a buyer, how would I know what's going to be the right price? Because like all this, the seller of that house actually knows, probably maybe they have a real estate agent who is going to be comparing those with the market, right?
It doesn't fucking matter.
Yeah.
It matters what your number is.
Okay.
What's the number that works for you?
Okay.
That's all that matters. Because it doesn't matter what a realtor thinks the price is. It doesn't matter what the seller thinks the price is.
Okay.
It matters what price works for you. And that's if you're okay making 50K, or if you need to make 100K on a flip, let's say,
Right.
you just work back the numbers and you say, that's the price I can pay for it. Yeah. And if it's nowhere near, if it's way less than what they say,
Yeah.
submit an offer anyways. Worst I can say is no. That help?
I have
All right.
a question.
Yeah.
So, there's a coach I'm listening to, and he said that.
Is it Dave Ramsey? I'm just
no.
kidding. I'm just kidding.
So he said that real estate is so sweet because here in Canada, the value always go up. Is that true for you? Like from your experience?
That statement
Yeah.
is true only because money gets devalued over time, right?
Yeah.
So it's not necessarily the asset appreciating in value always. It's about our money that's constantly depreciating and purchasing power increase with assets. So inadvertently, yes, it's true, but I think it's better to understand why it appreciates. Now, I also don't bank on appreciation. It's my cherry on top. I'm a buy and hold investor, so of course I love it, but there's more reasons, in my opinion, to invest in real estate specifically. And I think the biggest reason is that it's actually a self-liquidating debt. You are getting a mortgage at super low interest rates, and someone else is paying that debt down, right? I think that's one of the biggest things. Another reason is cash obviously is devaluing, so inadvertently our assets are appreciating over time. Of course, if you need to be cash flowing, I don't think anyone should buy anything that doesn't cash flow if you're holding it. And then there's tax advantages, not as much in Canada as there is in the US, but yeah, there's some there.
Now, second question. I have some friends, and they're usually scared that the prices can drop, just like, I don't know if similar to what happened in 2008 in the US. Is that feasible?
Of course it is.
Okay, that prices could go down.
Absolutely.
So how do you mitigate that kind of risks?
You always have a margin of safety, right? And you have multiple exit strategies or plans. But I think the biggest thing is having a margin of safety. And we use that term in stock investing, but also in real estate investing. So for example, if you're doing a flip right now, it's especially important because we're buying in a market that's not going up. We're buying in a market that we don't really know what's happening with it right now, right? It's vulnerable. So let's say the market was going up, maybe I'd be okay making 40 to 50K is my profit margin on a flip that I'm okay with. But because the market's uncertain and it's kind of going down, I need to make maybe 60 to 70K because I'm building in that little margin of safety. If I make 40K, it's still fine, but I have that margin of safety. And I'm building that in at the buy, right? When I'm running my numbers, I'm running what's my margin of safety? What is that profit margin? And if the market dips down and that ARV, after repair value, that's the sale price, if that dips down by 10, 15%, is that going to bankrupt me? Does the deal still work? And again, everyone has a different comfort level too. Some people are willing to make higher risk decisions, maybe because they can afford it. So they'll be okay with a lower margin of safety. If someone can't afford to lose that money, you need a larger margin of safety. But again, everyone's going to have a little bit of a different number of what their margin of safety is and what they're comfortable with and their risk level. Any follow-up questions? Okay, we'll move on. So where was I? We were at concepts that we can apply from flipping to developing. So having a good margin of error. With development, larger numbers, you're going to probably need a larger margin of error because it's not a $10,000 problem that happens, it's a $100,000 problem that happens. Depending on how big your project is. It could be $1 million problem, but maybe you've got such a large project and such a large margin of error that doesn't matter. Be well funded. Now, you don't have to have all of the money to do it. You can partner with people. Although if you have no experience, I probably wouldn't recommend that. But you can absolutely borrow investors' funds or partner with other people who have funds. You still need money, I think, for development. Sometimes with the flip, it's a small thing. You can maybe get away with it. You have enough margin of like safety margins and all of that. With development, it's like, okay, you're hit with a $30,000 bill and you need to pay it now. Otherwise, your permit's going to take 3 months longer. So you need to have liquidity, cash reserve, even credit reserves help, like line of credits. A finance plan, and the what-if scenarios. Now, of course, if you are a very cautious person, you probably have already thought of all the what-if horror story things that could happen, and then you talk yourself out of the deal. So you have to be careful with the what-if scenarios. You want to be absolutely aware of what can happen and aware of these things. And of course, there's always a level of risk with any investment that you do. You have to be aware of it and willing to take that risk and be able to recover if this risk happens. Any questions? Okay. So I'll tell you, yes.
What's the risk you have encountered recently that didn't account for?
Oh, I'm going to go through that right now.
Sweet.
So this was my first development deal. So I'm a huge advocate for partnering because if I don't know something, I will partner with someone who does know something. And for me, I didn't know anything about development. I did like short-term rentals and BRRRRs and multifamily, but I've never done development or building a building. So of course, I brought someone onto our team who was a developer and a builder. So the biggest difference between a developer and a builder, which can be one person, can be two different people. A developer is usually the person who's putting the plan together, getting the architect together, helping with the permitting plan, an overseer, project manager. Builder comes in and they are building everything. That's the simplest way to say it. Is that right? Okay, good. He's a builder and developer. I am not. I partner with people who are. So for this project, it was me. I have a business partner who's a realtor, and we complement. And that's the thing. We found each other, and our skills complement each other. And so if he's an extrovert and I'm an introvert, he's good at socializing, and then I'm the numbers geek in the background, and I'll stay on my computer for 10 hours. So it was me, my business partner, who's also the realtor. which helped because we actually were able to use his commission as funding as well for the deal. And then our third partner was a developer and builder, because neither of us knew what we were doing. But we really did trust this builder. It wasn't just someone that we met at a networking event. We had met him many times. We've seen his other projects. We are very, I would say, intrinsically good at understanding someone's character. And it's like, because they might be really smart, but it's if you don't have similar personalities or someone that you just clash with, things are just not going to be fun at all. And you want to have a little bit of fun, with development. So 3 partners on the deal. And I just want to make sure I don't miss anything. So, okay. So the biggest barrier, one of the biggest barriers was usually having you need a lot of money for the carrying costs usually because of the long permitting process. So with this deal, we had a long closing. So we got it under contract and it was like 9 months down the road was when we actually took possession of the property. So that was a huge thing why I was more comfortable getting into this development deal, because it reduced the risk by not needing so much upfront capital and not wasting a bunch of money. And because again, carrying costs added to your bottom line as well. So we, during this permitting process, didn't have any of the private lending carrying costs. So by the time we closed, we were DP, development permit approved, and we would be shovel ready. I'm telling you the plan and what actually happened, okay? So that we would be shovel ready by the time we closed, right? What else? We had a huge margin of error safety net as well. So we knew, being new to this, that we were going to make some costly mistakes. We baked that into it, and we would be fine as long as we didn't go way overboard, which we have not, surprisingly. So I'll get there. It's honestly pretty funny of a story. So yeah.
Could you describe the project so we can check the magnitude of the planning that you needed to do, or
Sure. So this was
that a multifamily or?
Yeah. So this was 2 lots and in Thorncliffe, and they were 60 by 120 each. So very large lots, and there's a house on each lot. And they were RC1, but obviously the RCG's, rezoning. But anyways, we'll get there too. So we calculated that we could do 20 units, 10 main floor units and 10 lower floor units. And I won't get into all of the details, but how you figure out how many units you can do is you calculate in the bylaw how many units per hectare you can do. Yes, exactly. So we could do 20 units. And we bought it, both lots together for about 1.6 million. And then our builder helped with the numbers for how much our hard costs, soft costs, all of that. And then we were going to end up in the end. Anything else you need to know about the deal? Okay, maybe we'll get there. But
Do you get into how much, you said you baked in a lot of safety net?
yeah, so we had,
Did you figure that out?
so based on multifamily, the value is off of cap rate, so the income that it can generate. So basing how many units we had and what the rental rates on average would be, we got our cap rate of, I think it was 5% we probably used because that's the standard in Calgary. And so that gave us kind of what our value was going to be afterwards. So then minus the build cost, the margin of error, and the land costs and all of that. Any other questions? Okay, so let's see, where was I? Okay. One of my first mistake was that we had so much time to close that we imagined we had more time than we actually had. It always feels a little longer than you think. And even though we knew the timelines, but we were working on some other projects too. So we didn't submit fast enough, I would say. So by the time it came to closing, we were close to getting our fully approved development permit, but not quite to get our MLI Select Construction financing for the purchase at the end. We closed. So we had to get a bridge financing. So some private lending that would help buy the land and close on it and bridge us for when we needed that construction draw mortgage. So we went with Calvert, and a thank you to, where is he, Brett? He's probably taking a phone call. So Brett helped us get this done with Calvert, and also extremely, extremely important to have a good mortgage broker because he saved our deal on closing day. And how he did that was because we didn't want to put all of our money into the down payment at closing. And Calvert allowed us to purchase the $1.6 million project with $100,000 down, which is crazy. But we had to collateralize equity in another property in lieu of cash down payment. Now what happened, sounds great, but the nitty gritty, right? So we had a property, it had the equity in it, I don't remember the exact numbers, but let's say it was $1 million property and the mortgage was $300,000, so we had $700,000 of equity. That $300,000 mortgage was a collateral charged mortgage. Does anybody know what that means?
They can go up or down.
So it means a couple things. The main thing is that on a collateral, the mortgage lender can securitize more than what the actual mortgage amount is, or register. And so they usually do that if you want to add like a line of credit later on, but you don't have to go through the re-registration process, and it's a lot easier. So they had that, which it turned from the equity that we could use from 700 to like 500 or 400. His mortgage wasn't that much, but that collateral charge on title was higher than the actual mortgage that he wasn't aware of. So we need to find another property to do another equity collateral on as well, or equity in lieu of down payment. So we have two properties, we have two other people now involved. And one guy was, another thing with mortgages. It's important to the story. There's like so much, I'll yap and yap and yap, so you can stop me if I go too long. But anyways, most A mortgages, and even in general, the first mortgage on title will usually say you are not allowed to get any second collateral on or second charged mortgage without our written consent, right? Now, most of the time, it's very common practice that people will put a second charge on that property because most of the time, the first one will never even know about it. That one will come and go super quick, and the first one will never know about it. They'll never call the mortgage unless you stop making your payments. So our lawyer decided to tell this to one of the people that were using using equity in their property on day of closing, and it freaked them out because he says, oh, by the way, your Scotia lender could call your loan at any moment if they find this out. And he's obviously like, well, I don't want that to happen, and like that's super risky. And Brett is like, I know all your numbers. If that happens, I got you covered. I know exactly, you'll get a new mortgage, I'll help you with that, like no problem. So we talk some, we don't avoid talking about the risks, but if they're so low, of course, someone who's never done it before, obviously they may not be comfortable with the risk. So anyway, so he helps us close on it. Where was I? So we close on it. We have a short-term financing. Of course, we only did $100K down, so we've got a pretty hefty interest rate, and it's $10,000 a month interest only. But of course, it's only going to be a few months, right? Because we're weeks away from our fully approved development permit, according to our architect that our builder had hired. And then our architect is gone. Can't call him, can't email him, can't text him. He's gone. He's disappeared. He's gone. It was weeks away though. So we contact the city and the file manager who was working on our development permit. Okay, like we'll just pick up where he left off. This guy hasn't done anything since the submission. I don't know what you're talking about. We've tried to contact him. He's done nothing.
That comes with the architectural license.
Good one.
Yeah. So now I'm thinking, how on earth did this happen? How did we not know sooner that he had done nothing? Anybody heard of trust but verify? Which I also, of course, learned the hard way, but we need to trust and verify. It's not trust but verify, because you can't ever, you wouldn't do a deal with someone if you didn't trust them, right? So trust and verify. So the builder, he could have done some simple things for the guy that he had hired to verify that he had done the steps, reviewed the detailed review document, all of these things. There are so many things he could have done. So in the end, we couldn't work with this builder because if he couldn't manage the architect for the development permit, what else could go wrong once we started construction? Oh boy, right? So unfortunately, he's still a good person. Maybe he had too many projects. I don't know, but we couldn't work with him anymore. We tried to salvage the development permit. We talked to a lot of different architects. No, you need to restart this whole development permit. The submission itself doesn't make sense. It's not good enough. I don't know what the heck this slop is. You might as well just restart. It's going to take the same amount of time for us to fix all of these issues. So to restart development permit all over again, all of that, right? And okay, where else? So there's development permit. I think there was something else. So
The holding permit.
So we paid this guy, the architect, $11,000. Should have been a red flag that he only cost $12,000. And we paid him in phases, which again, we should have verified each phase where he was at. There was a lot of things. Anyways, the builder should have known. But of course, we didn't know because we didn't know. So we trusted our builder and a developer. Okay, I feel like I'm probably taking up a lot of time. Okay. Do I have time left?
Why don't you wrap up the story with the big bow on it? Be like,
All right. Oh, okay. Okay. Okay, I don't think I've even. Okay, so what went wrong? So we imagined we had more time, the private loan. So we didn't just lose $11,000 from a bad architect. We lost $150,000 because of the holding costs, starting from scratch on the development permit. And you'd think, okay, easy, just sue him. I also found out suing people is not always the answer, and you usually spend a lot more, and you may collect. So it's never a fail-safe, by the way. Found that out the hard way. Okay. But they couldn't use all the equity. Okay, blah, blah, blah. Closing. Okay, another thing. 20 units, we said, right? So because there was a corner lot and there was a curve, we can't even do 20 units. We can do 18 units. But it's okay. Our deal is still fine. It costs less to build, but we're still okay. But we resubmitted at 18 units. But finding that out after we've closed and already had this for a year, and finding out our builder didn't tell us, the developer didn't tell us, I'm pointing at you, he wasn't the guy, by the way. Our architect didn't, no one told us. And I'm like, all of these people we had that could have told us. Anyways, and it was because of the fourth decimal point. If you rounded up, it was okay. If you rounded down, it wasn't okay. But we're already contextual, so you don't really want to push for 20 units anyways, because then you'll have more carrying costs because it'll take longer. Anyways, okay. Appealed. So once you get your development permit approved, you get your building permit, and then you're shovel ready. No. Development permit, appeal period, and anyone can appeal your approved development permit, which will extend your timing. Even if your project knows no changes, it can extend it by 3, 4, 5 months. More carrying costs. I'm not doing this to scare you. Just learn from my mishaps. Because I learned by just paying for them. All right. What else? Actually, that's probably pretty much it. I think I'm pretty much done. Yeah.
Question on CMHC draw, right?
Yes.
So when does that start? When does the first draw? Typically, I've heard is that you have to get up to foundations inspection done, and then they would release the draw. Is that similar with CMHC?
I've heard demolishing and excavating. They just want to see something's been started. So demo and excavation, and then they'll usually do your first draw. Yeah, I guess, we won't talk about financing today. That's another huge, long presentation.
Where's your project at today? This one?
We got appealed yesterday. Yeah, but we will start construction this year. Yeah. I have another development project that we're doing in Three Hills too. Very different development, but also trusted partners. So anyways, I guess if you want to learn more about my mess ups, you can connect with me on Facebook, on Instagram, Natasha Flemming. I also do some consulting, so obviously not on development yet. I wouldn't mentor on development at this moment, but I've done a lot of other things like multifamily flipping and BRRRRs, Airbnbs, a lot of other things. So if you are stuck in your journey, if you're not sure what the next step for you is, or you need help analyzing some numbers, whatever it is, I don't charge like $15,000 coaching or whatever. It's just, if you need a little bit of help, you can just reach out to me and I'll just do some one-off sessions or whatever.
Awesome.
But that's it. Yeah.
Right on. Well, now I'm going to tell you about all the things I did wrong in Natasha's deal. So my name is Mitch Hardington. I have been in and around the real estate development space since 2007. I started up in Canada, where I did a whole bunch of luxury homes, did some flips and a bunch of other things. And for the last 2.5, almost 3 years, my business has been solely focused in the United States. I still do have a small footprint here, but the point of the presentation today was just to talk kind of about the US, some lessons I've learned in both, and how, one, development is amazing. There are actually less problems when you learn the hard mistakes and you work with the right people, there are actually less problems. And I have found in development, there's actually significantly more profit too. So my plan and goal for you for the next, I'm going to power through these because I think questions are really important at the end. I'm going to try and download as much information onto you as I can in 10 slides, and then you can ask away. Cool? So who I am. I have said before, I've overseen $150 million in luxury construction. I currently have about $8 million under development right now in Pennsylvania. We have a 50-unit townhome development coming online. We also do co-living developments down in the United States. And I'm also a board member for a not-for-profit where we're focusing on sober living. I am a trained teacher. So I was a teacher for a while. I was then in law enforcement for a while, which is where I kind of gathered my grit and learned how to fight through the really bad things that happen in real estate sometimes. And then part of my journey also is I owned an HVAC company where I doubled the revenue in 12 months through a lot of learning and trial and error. So that's me. Why should you listen to me? You shouldn't. You honestly shouldn't listen to me, right? Trust but verify. It's so important. No matter, we go to events like this, we listen to people online and we watch their YouTubes and we're like, hey, this person seems like really cool. They know what they're talking about. The most important thing that I think I can stress to you is validity. There are so many people online right now who are saying, hey, this is what you should do in development, or hey, this is how you should buy a mobile home park, or hey, this is how you should do that. Awesome. They theoretically might be right. But what proof do they have? Can they show you a HUD statement of like, hey, this is actually a piece of land I own? Can they show you a HUD statement of, hey, this is an actual RV park that I own? Can they show you, here's a $100,000 bill that I paid to an insurance company? Can they show you those things? If they can't, might not be the right person to be mentored by. You could probably still learn things from them, but really just in the world we are living in right now, it's really important to verify the people that you're surrounding yourselves with. So the legal disclaimer, because in my presentation, I'm going to talk about underwriting. I've used some actual numbers from deals that I've used, and I've also used some hypotheticals. But the important disclaimer that I am required to put on presentations: one, I'm not a lawyer and I'm not an accountant. Please talk to your lawyer and accountant. This is not an offering of security. I am not trying to sell you anything. I have nothing to sell here today. I'm not trying to sell you a project that I'm working on. And this is for education. My purpose for here is to teach you kind of about who I am and what I'm doing. So, would you rather? This is where I think the more money, less problems comes in. If you took $1 million multifamily property at a 7% cap rate and you reverse engineer that, that means your down payment, you need about $300,000 down payment on that loan for a 70-30 loan. So you need about $300,000 down. Your NOI should be around $70,000 a year. If you have $1 million property and a 7% NOI, it's calculated based on a reverse rate. So it's about $70,000 a year. When you factor in your annual debt servicing, which I think I did at about 6%, which is kind of standard right now, you lose $50,000 off that. That means your cash flow after debt is $20,000. That seems pretty good, $20,000 a year, right? That's not bad, I'd be okay with that. However, you syndicated this deal, which means you got to give 70% of that away to your investors. Cool thing for the investors. The investors are now making $14,661 a year. You, as the general partner, remain your 30%, which is $6,200 a year as a GP. So, for having used none of your own money into a deal, that's not bad. $6,200 to kind of manage a property, get your feet wet, learn about real estate, grow your GP experience working with people around you. That's now an infinite return on your money at $6,200 a year. But if we look at development, development is an entirely different ball game. I don't know why that got moved. Very interesting. We compressed it. Anyways, in a development, you should earn a bare minimum of a 20% net return on your ARV, your after repair value. Usually your target is between 25 and 30% return. Okay, that's a bare minimum. I will not do a deal unless I'm making a minimum net return of 20%. Our target is 25 to 30. If the numbers don't match that, I will not do the deal, right? We talked about earlier about questions about margin of safety. How do you factor this in? This is how you factor those things in. If I'm underwriting a deal and my net return, I'm like, I might scrape away 10%. And then your contractor lights your house on fire and you're like, oh, well, that sucked. Now what do I do? Okay. So at $1 million after repair value of $1 million, you should take away $250,000 as a net return for yourself as the general partner. That is including after you pay your investors a fixed return of 30 to 40%. We generally pay our investors 30 to 40% fixed return on our properties, which means that you, if you're comparing GP to GP, you as the developer, builder, should have a net profit of $250,000 on the same $1 million property. Okay? So, more money, less problems. How do you get there? How do you determine getting that 25 to 30%? So in development and in all real estate, in my opinion, you should start with the end in mind. Okay? So number one, what is my after repair value? What is my ARV? And how do you determine that? Well, some people will go, well, I think it's going to be worth this. No. If you ever are thinking to yourself, I think it's going to be worth something, you should probably start all over again and go ask somebody what they think it's going to be worth and then not listen to them. Because in real estate, what you think doesn't really matter when you're talking about ARV values, especially when we have so much market data like we do today. So how do you determine the ARV? Well, let me go look at the solds in the last 90 days with the same bedroom count, the same square footage, and let me figure out what the actual market is paying for that right now. So once I've started with my ARV for my development, you can move into your land cost rule. Land cost rule says you should pay no more than 20 to 25% of your total ARV for your land. If you are paying more than 20 to 25% of your ARV for land, you're probably overpaying for your land. So you're already compressing your margins. Okay. Number 3, what are my build costs? So this is where you should have a relationship with a builder, or you should have some basic information of what is it going to cost me to build in this neighborhood, right? If I'm going to build in Los Angeles and New York or North Carolina or Dallas, Texas, all of those are going to have different values. It's no different than building in the city of Calgary. Aspen will have a slightly different value than Forest Lawn, right? Because we're talking about finishes, quality, all of that is different. So you should know what your build cost is, okay? Now you're going back up to number 1. Of those houses that I built, or I looked at for my ARV, what was their average square foot? Was it a 1,000 square foot home? Was it a 3,000 square foot home? And now you're taking that square footage from your ARV and you're multiplying it by your build cost. Okay, that's gonna get you what your total hard costs are. So then you go into your cost stack, which is your all-in, it's land plus build plus closing plus hold cost. All of that, when you add up everything, all of your lending costs, and we assume things like 6% of ARV for carrying costs, which will be your interest. We assume 4% for holding costs, which are some of your soft costs. When you add that all up, your total should be somewhere between 25 and 30% of what your assumed ARV is. Okay? So once you do that, well, where does it fall on the spectrum? And like Natasha was saying, what does it work for you? You know, are you okay if your first deal you're making a little bit less on the 20% side, might dip a little bit lower? Sure, right? You're gaining some experience. You might be giving away some of your money to a JV partner. There might be like other factors in effect, but where does it fall within that? 2, the thing that most people forget when we talk about construction is points on construction loans. So when a lender in the United States specifically, I'm not too sure it's the same in Canada, a lender will charge what are called points, which means that your total loan value, they're going to charge you anywhere from 1 to 3 points on the front end to originate that loan for you. Now you might be thinking, well, that sucks. I got to pay more money up front. Yeah, usually. But the nice thing about those same lenders is that they will include that in their total cost for you, so you don't actually have to pay it. The same lenders will also give you 90% of your loan to cost. Okay, a good construction lender I have found will usually between 80 and 90% of your loan to cost, which means when you buy your land, which is a cost, and your construction, which is a cost, they are going to give you 90% of that, which means you only have to come out of pocket for about 10%, which is where you can come out of your own pocket, you can find a JV partner, you can bring on a capital partner, whatever your strategy is. But don't forget when you're underwriting, thinking about costs, because I have made the mistake before where I underwrote a deal and I was like, hey, the land's gonna cost me 100 grand, I'm gonna build it for 250 and I'm gonna sell it for 5, just making these numbers up. And then as I went and started signing my loan documents, I'm like, this mortgage value is a lot bigger than I thought it was gonna be. Why did that happen? Oh, because my lender points and my interest rate and my underwriting fee and my document fee and all these little fees that sometimes lenders put onto your thing. So when you're underwriting a deal, make sure you know the lenders, the points, and those hidden fees that might be on there. Again, that's a little more specific to the United States, but I think, my own personal preference right now, there's a reason I moved my entire business from Canada to the United States for development lately. Because of, we are seeing these types of returns. I'll get into it in a few minutes, but how do you do that? It's all about relationships. Okay, everything that you are going to do in real estate or are doing in real estate comes down to the relationship you have with people. Who are you talking to? What are they like? One of my old buddies told me a story where he said, they should be able to pass the chug test. And I was like, what the heck is the chug test? He's like, if you're gonna work with somebody, you should be able to sit down with them at a bar and chug a beer together. And if you can do that, then they pass the chug test. And I was like, that was the dumbest thing I've ever heard. But now it's in my brain, I can't forget it. So when you are building relationships with people, you should be able to spend that kind of time with them. You should be able to sit down and be like, hey, how's it going? If you're just gonna sit down and all you can do is talk business and be like, hey, so are we gonna talk about our real estate development and the things that are going wrong? And by the way, have you seen The Architect? Right, that relationship, that relationship might get strained, okay? So relationships. I can't stress that enough. I have a story about that later.
can I just clarify?
No, I said no questions. Yeah, what's up? Development. Yeah, so that $1 million project is a single family home. It was like $1.1 million single family home that we built. I have projects right now that are $600,000 single family homes, and then we have developments that are multi-millions. The concept is the same. On any development that you do, the same principles apply whether you're doing a $300,000 mobile home park type deal, or if you're doing a large multifamily deal. The numbers don't really change.
Just for me to clarify, if it was a multifamily versus like a single family,
Yeah.
the first step would be going like, instead of calculating the ARV, you would just go with a cap rate in mind, or like.
So this is specific to build to sell. This is like simply profits. But in a multifamily deal, so if we're doing a 51 unit development in Dallas-Fort Worth, the very first thing we did is we took all 51 units, we factored out what the price per square foot selling is. We then took our total square foot and multiplied it by that based on some varying units. We get about a $20 million exit price. We went to that $20 million exit price, went what's 20% of that, and that is the max we would pay for the land. Kind of work backwards. A typical development should last you 12 to 18 months total time. Yeah. Your first 4 weeks are all about analyzing, right? What am I doing? What am I trying to build? What am I trying to accomplish? What is my hopes and dreams? What are my aspirations? How much money do I want to put in my pocket? And how much do I not want to give the government? Okay, these are questions you should be asking in the first phase. Next is site selection and land. Now that you kind of have this idea of what your goal is and what you're trying to build, now you can go look for land. Weeks 6 to 10, so we're kind of coming up to that 3 month, that kind of 3 month is phase. You're securing your financing. Once your financing hits, that is usually when the ease of your development starts. Development is made and lost in the first couple of months. When you're going through things like development permits, building permits, site selection, lender selection, contractor selection, all of that is the most important work in a development, and it's all on the front end. It's not like a flip where you're like, okay, I think I've got an idea. You walk in, you pull the drywall off, and you go, that's not what I expected. It's all done on the front side because a true development, it comes down to planning. The best developers that I know of, the best success that I have seen in development comes from pre-planning. The hours and hours you spend, the weeks you spend looking over contracts, vetting your contractors, looking at your timelines, building out your timelines, working that in with your lenders, seeing how it all fit together. Because if you're sloppy on the front end, you're sloppy on the back end. It's the thing I learned in my time in sports and in law enforcement. You're only as good as your preparation. So if you don't prepare well, you're not going to perform well. You always fall to the level of your training. You never rise to the quality of it in a do or die situation. Yes, you can rise in occasions, but if things are hitting the fan, you're going to sink back to, okay, well, what did I plan for? Oh crap, I didn't write anything down. Okay, I'm going to go back to my pre-planning meetings that I had with my developer or my builder. Oh shoot, I had one. Okay, what are we building? Interesting. I don't actually know what we're building. So all of that thought goes on the front side. So then once you have your financing secured, your permitting design is finalized, and then you're off to the races. This total time should be, like I said, usually it's about 12 to 18 weeks. Your build time of that is like 8 to 9, right? You should be able to build a house in kind of like 8 to 9, 10 months, right? Multifamily is obviously a bit bigger. That you start getting into like the 1 to 2 year timelines for actual construction. But on like a small single family house, where if you're new to development, I would suggest starting on a single family house, right? I wouldn't suggest starting on a multifamily property because there are so many more moving pieces. Let's not jabs at you.
Yeah, no. I should have gone first.
Yeah. Okay. So my top 6 things, and how do you mitigate your delays in and losing money in real estate, in development specifically? Number 1, wrong contractors. Does your contractor have a license? Bitch, why do you know that? Well, let me tell you a story. This one time I was putting in our contractor was putting in an HVAC system, and we went to get it inspected. So I went on to our online portal, I filed for the inspection, and I said, Mr. Inspector, can you please go and inspect the HVAC work? He says that his rough-in is complete. I got a phone call. What HVAC? And I was like, well, the HVAC we have in. He's like, you don't have a permit pulled. I'm like, oh, that's no problem. I can get a permit pulled. So I call the contractor up. I'm like, hey, I need you to pull your HVAC permit. He says, I can't do that. I said, what do you mean you can't do that? I'm like, you're an HVAC guy. He's like, yeah, I don't have a license. And I went, oh, well, that's a problem. So what did I have to do? How do you solve that problem? Well, I had to call another HVAC contractor to come in, inspect his work, and put his name on it. What do you think that cost me? Well, it wasn't free. So that comes out of your risk mitigation of like, oh crap. So I now had to spend an extra, I think it was like $3,000 to have this guy come in, and every contractor is like this. They'll walk into the building, they go, hey, this is really good. Oh, you want me to put my name on that? Okay, well, there's a few things that I'm gonna do to bring it up to my standard, right? Because they're putting their name on it. They want things to look the way that they want them to look. So that's gonna cost you money. The second one is the comparable work and the ability to do work. Have they done something like this before? Have you built a new house before? How do I know this? Well, recently, unfortunately to say, we all make mistakes. It's a learning process. One of my contractors recently on one of the builds I have in right now, I just found out recently that they put sheeting on the side of a house that isn't supposed to be there. It's like, well, what do you mean? They put plywood on the side of the house. Isn't that what you put? Yeah, it is. Except for in the plans, when it specifically says in the plans that it must be a fire-rated gyprock. So they actually had to put fire rating siding on the side of the house. Okay, well, that's not that big a deal. You take the plywood off, you put the siding on, not a big thing. Well, what happens when the contractor doesn't tell you about this and sends you photos that are slightly altered or not showing you the work they did? Well, how did they do that? Well, because they put the siding on the house. Yeah. So if your contractors aren't up forth and front, like forthcoming with you, that's a big problem. Now, were we able to mitigate this? Yes, this isn't going to be a big problem for us because we have steps in place. And part of that is don't pay your contractors until they're done the work. Okay? If you are going to hire somebody that needs to get paid every single week, don't hire them. How do I know that? Because I've done it. And then they bill you to come back and fix their mistakes. It's very annoying. Which is number 2. Document scopes, lien waivers, and inspection reports. If your contractor is asking for money every week, not the contractor for you, you can pay them in stages, and I usually use 3 milestones. Number 1 is a deposit. I will give them anywhere from 10 to 20% as a deposit where they can buy the materials. We secure them on for like in the timeline. Number 2, we will give them the majority of we'll give them another small payment the day they show up to work. Okay, if they said they were going to start on a Tuesday and they show up on a Tuesday, I'm now wiring them another small draw. It kind of brings them up to that 30-ish% area. Okay, when do they get their next payment? Not until they pass an inspection. We don't pay them another dime until they pass the inspection. And every trade, most of them have an inspection point. If not, there's a few that don't like drywall. That's pretty easy. You could walk in a house and go, is it drywalled? Okay, if the answer is yes, you could pay them. We pay them the remaining 30% when their work is done. So just because they pass inspection doesn't mean there's done. You know, on framing, they have to come back. There's blocking they have to do. Sometimes there's little tweaks. Maybe there's some things we get to move around. That's all worked out in our contracts beforehand, where we're not paying them until certain milestones are met. And then we retain a 10% of their total contract price. We retain 10% of the total contract price for what's called a punch list at the end. When the job is done, what needs to get fixed? If you've given them all their money, like for example, you've given your cabinet guy 100% of his money and you come back and the door is broken and fallen off because he broke it, it's really hard to get them back. They're like, oh, I'm busy. I got this other job. I'll see you in a week or a year. And you end up having to do it yourself. So number 2, don't pay them until milestones. Permit delays. This is another big one. Make sure that before you are going to secure your financing, you actually have either your permits in hand or some sort of written document from the city saying your permits are in process and should be expected by date. Most planning and zoning committees will tell you this. hey, I would like to do this project. How long is your timeline? Well, we're about 3 to 6 months. Great. So when I put this in, where am I in the queue? Well, you're number 48 in the queue. You can have these conversations with your development and planning people. You just got to call them. If you try doing it online, you're going to run into the Stonewall AI who's going to respond with nothing. But if you just call people, generally you can find the right person who can tell you, yeah, this is what it's going to be. Number 4, cost overruns. The biggest lesson I can give you here is fixed pricing. Lock in your scope of work with your contractor. Some people will try and say, hey, you know, it's probably going to be, and they say the word about. Don't do about. About doesn't work for me. What is your scope? Okay, what are you going to do? What's included? What's not included? And this is where working with somebody who's done it before is really important, because a contractor might give you something and you think, hey, this looks really good. They're going to give me a really good price. Okay, but what's included? Are your tap-ins included to the sewer? Oh no, that wasn't included. Okay, well that's $10,000, right? Let's add that. What about your moving of the utility lines because the city's mandating you put them underground? Is that included? No. Okay. Do I have to move utilities? Am I by a fire hydrant? Do I have to test the fire hydrant? So all of these types of things get them locked into a contract. That's why contracts are so important, and stick to that, because if they're fixed in a fixed price contract and they walk away, you're probably going to be okay because they've done a certain amount of work to a point and you haven't paid them yet. You're like, you didn't get to the milestone. So if you do have to bring somebody back in, you still have a chunk of budget left and you're not having to go back to your lender and saying, hey, Mr. Lender, can I have more money, please? And he says, no. It's very unfortunate.
You see that a lot.
Yeah. Market timing. This kind of goes to underwriting. I've seen lately a lot of people that I've been helping through development. When they're doing their ARVs, they're bringing stuff that's like a year old. Okay, the market changes so often in development, and because it's a 12-month process, if you're looking at an ARV that's already a year old and your development is going to be another year in advance, that's a 2-year window. That's not super helpful. You should be looking max 90 days. Okay, and you can use your local realtor who should be able to pull actual comps from you, kind of going back and say, what does this actually look like? And then legal exposure. In the US, we use a lot of LLCs to shelter stuff like that. One thing that I can't overstress enough is insurance. I think a lot of builders out there will try and get the cheapest insurance they can, but for like a few extra $100 or $1,000 to get a better coverage and easier company to work with, it just saves you in the long run. Like, yeah, you might try and save your $1,000 now, but what happens if in my example, for example, where the contractor, had a leaky roof and put plywood on the side and I had paid him? Well, what do? Well, I got to make an insurance claim because I hired him to do a job. He didn't do it properly. I have to make an insurance claim. What if my insurance is a pain to deal with? And it's going to take me 6 months to get money from them or go through an adjuster and all of that, where I could have just spent an extra $1,000 on the front side to get an easier path or a reduced upfront payment that I had to make them, right? In development, it's rocks and pebbles, okay? Insurance, really important. Where you get your lumber from, not so important, okay? Wood's wood. You can go for your cheaper price on your lumber, right? But on things like insurance, probably more important to pay for. Risk is managed before the first dollar moves. Oh, sorry, I had to do that one. Okay, so why development and why now? I think some actual stats right now. And I would make an argument that Canada is in the exact same position due to the affordability crisis we're having in Canada as the United States, but these numbers are based on United States data. Right now, the United States is short 4 million homes nationwide. They need 4 million homes today. The White House actually put out a study that said they need 10 million homes. So, I don't know, maybe they're trying to push something through to make building easier? Not sure. Last year in the United States, based on a census, 1.37 million homes were built. Okay? That is only keeping up with the current demand. So every year, based on growth in America, they need about 1.4 million homes a year. They can only build about 1.4 a year. That means they're only keeping up with the current demand. They can't meet what they need. So as a developer, that means if you have a good team, you have good relationships, you know how to buy well, and you know how to manage your teams, your market share right now is $4 million or 4 million homes. Okay, if you're going to make $100,000 on a home, you could do 4 homes a year and make $400,000 on 4 homes. 4 homes out of the $4 million shortage, we're not even talking like 0.0001% of like the total market cap that's there. So there is a massive ability right now in Canada and the United States to enter the development era and be primed for years and years to come. One of the coolest things that I actually just saw the other day, on June 1st, Berkshire Hathaway just purchased for $8.5 billion Taylor Morrison, which is one of the nation's largest home developer and builders. Okay? They already own Clayton Homes, and they have stakes in Lennar and NVR. So they now have major stakes in 4 development and building companies. If we can take anything out of the playbook of Berkshire Hathaway, is that they know what they're doing. They've got billions of dollars in market research. They know where things are going. And if they're betting $8.5 billion cash that they just paid for this company out of their cash reserves, if they're putting $8.5 billion on, hey, I think development is the thing of the future, I think we as the people who are wanting to develop can go, I think they might be onto something, right? If they're willing to put that much money into it, I'm like, I think I'm in the right space. I think I'm doing something right. Okay, 2 markets right now. So Dallas-Fort Worth, in 1 year, saw 123,000 new people show up. Okay, can you build 4 homes for those people? Probably. That's 1 a quarter. You start 1 home a quarter, or 1 a year, right? That's an extra $100,000 you put in your pocket. Florida is growing at roughly 9% a year, their population. There's a massive influx to these 2 states right now from everywhere. So can you build 1 house? Absolutely. Can you build a single $1 million home in these markets? Absolutely you can. Can you build 2 $500,000 homes in these markets and make the same profit? Absolutely you can. Okay, how do you do it? Well, like I explained, you start with your ARV, work your way down, build your relationship with your contractors, find people that you know, like, and trust in those areas that can help it happen. One thing that I've come to learn with development is it doesn't have to be a full-time job. It shouldn't be a full-time job. You should be able, when you have the right team and the right people around you, you should be able to run your developments and your builds a couple hours a week. Because you're the owner, you're owning the thing, right? So you should be having calls with your general contractor on like Tuesdays and Fridays. Hey, what's the plan for the week? What did we get done? Can I see some photos? There's so much technology out there right now. Like one of them is called Builder Trend, which we use, where it has all of our schedules lined in. The contractor, they just take photos of their work every day. And yeah, I go online and I go, oh yeah, looks good. Okay, we're on track. And then on Friday, I have my 1 hour meeting and say, okay, so what happened the week? What did we overcome? What do you need? And you should be able to run it with only a few hours a week. Now, as you grow and scale and you have multiple builds, that time grows. Now you start needing a team, okay? But if you wanted to build like right now with the time that all of you have, you can easily do 1 to 2 homes yourself and with the time. So, brings me into the how do you get into development? Okay, there's 3 ways. Number 1, you can do it yourself. Has the highest profit and the highest responsibility. Make the most amount of money if you do it yourself. Okay, so there are there's mentors out there you can pay. You can go learn by trial and error. I would not recommend that because I've lost a lot of money doing that. 10 out of 10 would not recommend doing it by trial and error. But the easiest way for you to get into development is to do it yourself. The second is to learn by doing. And like Natasha said, I'm a big proponent. It's actually how I got started in development. Well, actually, I got started pushing a broom on a construction site. I was the construction janitor. You can learn by doing. Okay, so you can form a joint venture with somebody. You go, hey, Stephen, I really want to do a joint venture with you in development. How do we do that? And Stephen goes, well, you know what? I've got the entire team and the network built out. If you help me find a lot and help me raise some of the capital for it, you can come on in and be a partner with me. Hey, cool. Now I can split profits with him and all I have to do is a little bit of my own legwork. I can bring my own capital if I want to, or I can go raise it from my network. That's probably the safest way to get into development. If you actually want to be the developer. Now, if you want to do like the safest way, well, there's this put your money to work, right? Become an investor. Right, I think that's what we all want to be one day, is we don't want to be the worker anymore. We would like to just be the investor. That's the easiest way to do it, where you invest alongside an experienced operator and make returns on your money. This is best if you just want it, like I would love to do. just go sit at the beach and do nothing all day. Maybe think about what I want to do next, and then think about the other thing I want to do next. But that would be the lowest barrier, is just, you know what? Invest my money. I trust you. Make a development for me. Okay? The only wrong thing you can do, and every single mentor out there has said this, every guru has said this, every presenter will ever says this, the only wrong thing you can do is not do anything. Okay? We can quote I don't even remember who says it, the best time to plant a tree was 20 years ago, the second best time to do is now. Okay? With development, there's so much you can do. As we've seen in Canada, we used to have a very strong single-family home market. That has dwindled. Okay? Now it's more of a multifamily MLI select market where you're building row homes, townhomes for rentals. If you are good at and you have a good team, you should be able to build in every market cycle. Which means when the market is hot, you should be able to build single family homes and sell them and just take the profit and run. When the market slows down, like 2008, like I was building, I built through 2008 when the housing crash happened here. As long as you know and you have a good team and you can adapt, you should be able to build in every market cycle. So in 2008, we shifted from single family homes. We were building like $600,000 homes, and we shifted into high-end luxury, so multi-million-dollar homes because the recession wasn't affecting them. And we also switched into rentals. So we built rentals, right? So when the market shifts again and goes, hey, you know, it's starting to get stronger again for now the market has come back, people are making more money, they can afford to buy their own home. Cool, I'll transition back into that market where I will build them their homes to sell. And then when that market gets too hot again, I will go back and build rentals. And it's just a cycle. You should never think of, well, development is only build and sell. It can be for a while. It shouldn't only be, I'm only gonna build rentals. It can be for a while, but a good business has both. You have your now money and you have your forever money. Thank you. I was like, ooh, that's stuck. Your now money and your forever money. What are you doing right now, okay, in real estate? What are you doing right now to make money? Do you have a day job? Are you wholesaling? Are you flipping? Like, what is your active income that pays you today? What are you building on the side, additional to that, that's gonna pay you forever? Because when you stop doing your active thing, it's gone. You have no more active. At that point, your passive should be big enough where, oh, now I'm just collecting the cash flow off these things. That's me. If you want to connect with me, you want to get in touch, you want to learn more about me, that's my QR code. And then our companies are all on the side.
Yes. You guys all enjoyed that as much as I did. So we're going to throw Natasha up here and we're going to put them in the hot seat. We're going to do a little bit of Q&A. So just fire off your questions. We'll pass the mic around. We'll do this for 10 or 15 minutes and until, well, or if there's no questions. But I think you guys have all seen that these guys are pretty smart. They know what they're talking about. And I think we've got lots of good questions for them. So we'll do Q&A for about 10 or 15 minutes and then we'll do some networking. So. Sorry.
Thank you for the presentation. Must be the simplest question that we'll get today, but just for me to understand, when you have a delayed closing, as you mentioned, like it was like 9 months, sorry, Natasha, to you, it was in 9 months. And when you start the development permit process, what is usually enough for that development process to start? Is it just like a purchase agreement with like some deposit, or you need more than that?
So we had to basically just get a letter from the owner who was on title, and they had to give us authorization to be able to submit our development permit. That was pretty much it.
Thank you.
I'll go backwards. The margins that you're speaking of, Mitch, 20 to 25%, that's very high. Here in Canada, it's 10 to 15. Like 20 to 25%, you can do those?
Yep. Yeah.
Second thing is on your development cycle. I would add one, so in mine, I've done development. In mine, there's another layer, one more box. It's the financing on the construction. So there's two financing, just to be clear, the audience here
So in the United States, there's only one financing piece. So the construction financer is also the land financer. They come in and do the entire thing in one bout.
Fascinating.
You can do it either way.
Yeah.
Depends on the structure and the closing time.
Yeah.
Okay. Because here, so MLI, so we buy the land, get it to DP, and then we go to MLI for construction. So there's two phases of financing if one's going to do MLI. So if anybody here is doing MLI, just know that there's two phases of construction approval. Financing approval. You buy the property, and then you'll need your construction financing. And then the third, when you term it out. So there's actually three on the MLI if it's a hold. Yeah.
Nice, no question. I like it.
This one, I guess, is mainly for Mitch. The question is, how did you get into the USA investing? Obviously, you switched at some point and you're in Calgary. So how do you pull that off?
So because of my background has always been in construction and in and around it, I found, similar to what Peter was saying, the market here was getting squished, right? You're not getting the same returns. The regulatory issues were more challenging. So it was about 2.5 years ago, 3 years ago, I started doing a US-based mentoring program because I thought, you know what, I'm just going to buy flips, I'm going to do creative financing, and I'm going to buy single-family homes. I did that for a while with like zero success, like literally no success. So it was one of those moments where I had to really reflect on myself and be like, okay, well, why am I trying to do something that I'm not good at? Like my strengths all lie in construction. So why don't I bring that value to somebody? So it started with JVing, where I found people that lived in local areas and I helped them build out teams where they lived. So they lived in Dallas-Fort Worth. I would help them find their builder. I'd help them vet. I would go down and meet with them. I would meet with the city planning department. I actually built out little teams like that because I knew the questions to ask. Right, I can talk to a contractor and be like, BS meters is massive. Like you're full of it. So that's kind of how I have built the companies that I'm a part of. All of them have partners. None of those are by myself because I also believe in partnering. So every company that I have has a local person, or we've grown so much that we actually have boots on the ground in various areas. And as that grows out, and you kind of become more confident with that, you can start developing relationships with like builders like directly. So in one of our builds, our North Carolina build, our boots on the ground will actually be our builder. But I've built this relationship with them for probably 2.5 years, to the point where I've seen their work. I've watched them take things full cycle. I know they actually complete what they're going to say. I've looked at their HUDs. I've looked at previous HUDs like from recently, and HUD is like a closing statement in the US. It's called a HUD. So I've become friends with them. I've met with them. I've broken bread with them. So at this point, I'm comfortable to trust them to run the project. And you might say, well, that's crazy, Mitch. How can you let somebody do that? Well, it's no different than investing in the United States where you own a multifamily property. Are you there checking the toilets? Are you there speaking with the tenants? Are you doing those things? No, you have a property manager that does that. And you're now managing your property manager. My model is the same. I manage builders, I manage contractors. I just do it from somewhere else. And then I've just built up like LLC structures to allow me to do that, to move funds legally between borders.
So part of getting to different states, like you're in obviously Pennsylvania, that's crazy. You're in Texas, you are in North Carolina. That's all over the place.
Yeah.
That's a lot of builders.
It is. Yeah.
So how did you, I guess you started expanding the states, you didn't get too far with that. So how did you start connecting with a few builders to be able to start to gain traction and move forward to you're nationwide in many ways?
The builder network isn't as big as you'd think it is. Yep. There's a lot of good people out there who they'll have a good reputation. And as I've grown, I've actually started to build relationships with larger builders. So one of my builders actually is in 4 states, and they have a presence in 4 states, and they kind of have like a franchise model where they own a company and they franchise out like builders in various areas. So I'm tapping into that network to meet people in the right areas and again, go through the process where vet them out, ask them questions, go there, meet them, see their work. So it is some upfront travel, but again, that's I found the key to development. It's the first couple months of like, is this going to work? And then once it starts rolling and the the construction financing is in, it just becomes like a draw process of, hey, I'd like to get paid. Okay, cool. Show me your work. Okay, well, here's photos. And then if there's something that I don't quite trust, I've built out friends across areas where I can get them to drive an hour for me, and I'll throw them like some money for doing that. Be like, hey, can you just go check on this so I don't have to get on a plane? Or if it's something I have to get on a plane for, I'll just get on a plane.
So do you reside in Calgary constantly, or
Yep.
do you
Yeah, I travel a lot, but I live here.
do you have a state that you actually make your home as well?
Not yet.
Just all Calgary. Okay.
Yeah.
Thank you.
Yeah.
For financing in the US, are you able to get financing with your Canadian credit?
Yeah. So at first I wasn't. I had to get what was called an ITIN, which is a foreign investor social security number. And it's the same process as a Canadian SIN. Yeah. It just took like 6 to 7 months to build it up. So you start with a credit card, you kind of buy some stuff, and then you start getting yourself put on some loans. And now you have credit that I can apply for things myself, just like I live there.
And also TD Bank and Royal Bank is there. So would TD Bank USA consider your Canadian credit for qualifying?
I don't know that. I've never used TD Bank. I've never used RBC Bank. I only bank with BMO because I found that the Canadian BMO to the US BMO is very seamless, but then all of my US banking is in US banks. And then when I pay myself, I just do a wire transfer to my BMO and bring it back to Canada.
So within this, so BMO USA, BMO Canada.
They talk. Yeah. And then nothing else is connected. That's all separate.
Sorry, just to follow up with what you asked with your ITIN, I have one. My hurdle is you need like a residential address down there. Did you overcome that too? Or how would you go about that?
I use a friend's address sometimes.
I know, meet your friend.
No, and then so you don't necessarily need a residential address sometimes. You can use, as you grow, office, you can rent an office space and use that as your mailing address. So there are ways around it, but it's all about what works now. If you're just starting, those are hurdles you don't necessarily need to overcome. Like my first development was with somebody that lived there, right? So it was like, hey, friend, we're going to do this together. Okay, so they were the credit sponsor there, and I came in with I know some stuff, maybe. Let's try not to screw this up together. And then it grows from there.
Okay. So you can actually get addresses in the US. So non-PO box, we'll say suite number, blah, 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 this address, and you can.
Yeah, there's companies you can pay for. There's one that's $150 or $300 a month that gives you a residential address.
Oh, okay.
Yeah.
It's just basically it's a PO box.
Yeah.
The thing is, don't put PO box.
As
You
the
can put
suite,
suite 113, and they know that it's PO box. Okay.
Anything else?
Yeah, my question is related to the MLI Select. So would you I want to know your idea, why did you start developing the whole process by yourself compared to what it is already in the market? There are some, buildings that's already available that already has all those MLI Select, requirements. So why did you choose to develop everything from scratch? And you had to go through all of this unless you're doing it for your learning purpose. But yeah, what was the thought basically?
Sure, some learning and some experience, but more money, right? You're doing all the work. So if you're buying something that's already built, the person making the money is the developer. You're buying something probably turnkey. And I've actually bought lots of existing buildings from new builds. We just closed on 36 units where the builder built it. He did all the hard work, and thank goodness. And we just closed on it, rented it out, and used MLI Select. And that was great. But you are, let's say, doing MLI and you're doing 5% down, you qualify to do 5% down, that money stays in the deal. But if you're doing development, you're kind of you can do a BRRRR strategy, which in BRRRR strategy, you basically are collecting free properties. That's the idea. That's the ideal, right? So development, you can have a free property. It's this build is a $6 million property that I'm going to own for free. That's going to cash flow because I'm the developer.
Any questions? All right, let's give a big round of applause for our amazing speakers. Thank you so much. A couple quick announcements, something exciting coming up. So we talked last time about a new space. As you guys can tell, it's getting a little crammed in here. So we decided not to host an event next month because it's the middle of Stampede Week. So there's lots going on. We figured we would just be noise. We'd get 10 people here to eat pancakes or something, and you guys would all rather be, doing some hooting and hollering and stampeding. There you go. So we're going to skip July, but we're going to come back in August, and we're going to be in a new space. So if you're not a part of our Facebook group, I think we have a QR code somewhere. Make sure you scan and keep up to date with our updates. So we're going to be at the ATB Entrepreneur Center on 17th Ave, which is great. It's more than double this size. And ATB is going to be sponsoring us to allow us to have the event there. So that's super cool to have them on our team. And what are the things we got here? Facebook group. Cool. So about 2 weeks ago, I got the opportunity to travel down to San Antonio. And I'd never been to San Antonio before. It's a very cool city. So it was an Owners Club event, and Pace Morby, Jamil Damji, and Jerry Norton were all there. We got to meet and network with everybody. Super cool. And one of the events, we did a networking event. And the goal was basically to go around and to find out what everybody needed. And so everybody's here. They're looking to learn. They're looking for a deal. They're looking for capital partners. They're looking to JV something. And so as you go around the room this evening after we break, I would invite you each to try to learn and understand what everybody needs. And I think by the end of tonight, there's a good chance that we will be able to connect some dots and be like, oh, I know a guy that needs that, or I know a guy that has that, or I know a person or a woman, or sorry, I'm using guys all the time. I know somebody who needs that. And so I think by the end of tonight, if we do a good job of networking, I think there's no reason why we wouldn't be able to add about $1 million worth of value to everybody in this room. And so that's the invitation after we break. Stick around, hang out, network, and find out what everybody needs. If you haven't met somebody, go and shake their hand and ask them what they need. After you find out what they need, they will most likely ask you what you need. And then we can just continue to grow. So I'll invite you guys to do that. Let's give it one more round of applause for Natasha and Mitch. Thank you. And a big thank you to our sponsor, Lions Den. And we'll see you guys in a couple months. Enjoy the evening. We'll have some snacks and some networking, and stick around as long as you need.